All right, ladies and gentlemen, welcome back to a new video. And in today's video, we are still on first-time home buyer segment, baby. Yes, this video, we're going to be talking about qualifying for your home loan. What you need to do, how you need to get yourself set up. Let's get into it. All right, guys, before I get started with the video, as always, I want to introduce myself. My name is Raymond, and I am a real estate broker here in Atlanta. I work with buyers and sellers that are looking to relocate, or if you're already here in Atlanta Metro, buy and sell a home. That's what I do every single day. I love it. And I want to hear from you. If you are thinking about buying and selling, feel free to reach out to me. All of my contact information is on the screen as well as behind me. So feel free to reach out to me accordingly, okay? So let's go ahead and jump into the video, and we're not gonna waste any time. We're gonna just jump right into it. Qualifying for your home loan is probably one of the most instrumental aspects of your entire real estate transaction. And that is a big comment or a big statement because so much is hanging on what you do in this step that will determine how your other steps, how smooth they are. For instance, if you are working with a lender that has the ability to do what we call to be determined underwriting, which is send you through underwriting prior to you actually even starting your home search, that's going to give you such an advantage over other buyers that have to come in and request, say, longer finance and appraisal contingencies, because not only are they just waiting on the appraisal, but they're waiting on them being vetted as well. Whereas if you're working with the right team, you get to skip all of that, all right? And you are already vetted and you're good to go. It's just a matter of, hey, let's get that appraisal back and make sure that the valuations are good. And that can even be a little bit more shored up with the right realtor. So obtaining your financing is truly paramount. Well, obtaining the right lender is really water under the bridge if you're not prepared, right? So in this video, my goal is to give you some of the things that you need to be preparing for as it relates to the qualifications for a home loan. So I'm going to give you the actual characteristics or the categories that you need to make sure that you are qualified in, which will ultimately make you qualified for the home loan. So the first category I want to talk to you about is essentially income stability. All right. And I may be shifting my eyes and my head. I apologize now because I want to make sure I'm giving you these notes properly. I don't read from a teleprompter. All of this that I do on my channel is straight up from me to you. So I don't sit here and write out a script, but I do have a outline that I want to make sure I tackle. So let's get into it. The first one, the first thing that you need to be concerned about is your income. The amount of income is important, but you can qualify with lower income. I don't want you to think that there's a certain magic income that you have to qualify for. Your income can be your income, okay? But here's the caveat. It has to be sourceable income. It can't be, I just magically make, $80,000 a year and there's no paper trail behind it, right? So it has to be sourceable, okay? And if you're working for an employer, it's gonna be sourceable. If you're self-employed, same thing. Has to be sourceable. Self-employment, I'm gonna make another video on self-employment because it's a little bit different, but I'm gonna sprinkle it in here on this video. But I am gonna make a completely separate video just so that you are so that I give it the proper due that is required, because self-employment is such a different beast. All right, but number one takeaway, income needs to be sourceable. All right, the amount can be whatever. I mean, it needs to be a livable wage, but it needs to be sourceable. The number two thing they're going to be looking for is your employment history. How long have you been with that current employer, and how long have you been in the industry? I think this category is one of the most well-known categories, which is, hey, you have to be on your job 2 years, or you have to be in that same industry for 2 years. And that is it. You can't just instantly get a job and then go buy a home if you're entering into a new industry. This is one of the biggest reasons why people become unqualified, because they make that career change before securing their home. And sometimes I always tell my clients that, well, if you have a new career that's coming up, that you're in school and you're about to graduate with a new degree or a new certificate, can you can you do the transaction before you enter into that new career may prove to be beneficial. Because if you can, then obviously buy your house first and then go ahead and make that career change. But it's very important that you understand that employment history needs to be 2 years either at the same employer or in the same industry. So for instance, you could have a brand new job that you haven't even started yet. As long as you got that 2-year employment history in that same industry, you're good to go. Offer letters are acceptable. The caveat with offer letters is this: you have to go to that job and you have to get your first pay stub for most lenders before you'll be able to close. So you can qualify and you can get pre-approved and we can go out and shop and we can do all of these things, but you have to go and get that first check as a contingency or as an item that has to be turned into the processor before they will clear to close your loan. All right, so it can be done with an offer letter. If you're sitting there wondering, well, what if I get an offer letter? You'll be good to go. Well, you got to set up your transaction in a way that if you need short-term housing, you think about that before. For instance, if you're relocating from a new state and you're relocating for a new job, we get you set up with my lender. We get you qualified, and you're pre-approved through underwriting, with the condition that you have to produce that first pay stub. You got to go to the job. If your job is in person, you have to go to the job to work it. So you're going to have an interim period to where you can come here, go to work, get the first check, turn it in, and then we close, right? So you have to think about those things as well, which we will always identify in step 1, which is the consultation. All right. So now let's move on to the next category that you need to be concerned about when obtaining your mortgage. So this is a big one and a normal one: credit score. So what is the credit score that you need to qualify for a home loan? Now, before I answer this question, I do want to say this: there are 4 different subtypes of loans, right? You have FHA, which stands for Federal Housing Administration, FHA. That loan is a federally insured loan. Okay, we call it mortgage. You probably heard it as mortgage-backed securities, or a mortgage-backed product, whatever. But it is a loan that is insured by the government. It is not issued by the government. The United States government do not issue home loans. They insure them and back them with the actual lending institution. Okay. The second category of mortgage loans are going to be conventional. All right, conventional loan basically means any type of loan that is not insured by the federal government. Basically, it is a conventional. It is a regular loan, right? Not federally insured by the Federal Housing Administration. All right, the next type of loan is a Veteran Affairs (VA) backed loan. Okay, so same difference there. VA do not give the loan, but they insure it with the actual lending institution. And then the fourth one, in my opinion, is still conventional, but it is gonna be what I consider to be a creative type of loan, which we'll talk about too when we get on that self-employment video of self-employment loans and different type of structures there. So in my mind, I always tell my clients there's 4 options. There are 2 that are right off the bat that you can qualify for, in most cases, depending on your credit, which we're gonna answer in a second. FHA and conventional is open to everyone. VA is only open to those members that have served or family members of individuals that have served in the United States Armed Forces. All right, so that's pretty much it. And then the creative loan can be also for everyone as well. Now, let's talk about it and break it down in its own place. FHA. The minimum credit score for FHA is 580, okay? Now, here's another important takeaway. The credit score that they're gonna use is what we call middle score, all right? If you pull all 3 of your bureaus, so you have Equifax, Experian, and TransUnion. If you pull all 3 of them and you write your scores down, the middle score is gonna essentially be the score that is in the middle between the highest and the lowest. So it's not going to be the highest score. It's not going to be the lowest score. It's going to be the score that comes right in the middle between those figures. Now, if you have a double score, like if you have Equifax is a 625, Experian is a 583, and TransUnion is a 583, your middle score is essentially 583. All right, so that's how the actual credit score is determined. Now, for FHA, they want to see a middle score of at least 580. That is from FHA standard, right? And I know this gets complex, and I'm trying to keep it as basic as I can, but I also want to give you more, right? So now, FHA is the company, or is the government, and they have their parameters, which we call in the industry the baseline, okay? Each lender gets to determine how they want to, give their mortgages. We call that an overlay, okay? So essentially, you have your baseline, which is FHA, that says, hey, we will insure every loan that comes to us with these parameters. And one of those parameters, since we're talking about credit score, is going to be 580. So they'll touch anything with 580. Now, the actual lender, say Bank of America, since I just came up with that. If Bank of America say, well, great, FHA will insure 580, but we want to see a 600, right? Each individual lender can make that determination for themselves, okay? So just because FHA is the minimum, sometimes I've seen in the industry that they will have an overlay that will be more restrictive than the minimum. But it's safe to say, in this time and age, in this day and age, in 2022, September, you can get an FHA loan with the middle score of 580 from several different lenders, okay? Overlays have been dropped. It's not as restrictive as it once was before, all right? So in essence, credit score for an FHA is 580 middle score. For conventional, in most cases, it's gonna be a 620 middle score to jump up to a conventional. And most of them really wanna see a 640, but I've seen it done at 620. But 640 is kinda, really a safe estimation for a good conventional mortgage. Anything over that middle score is gonna obviously yield better interest rates. And then for VA, it's gonna be in conjunction with conventional. Most VA loan lenders wanna see 640 or higher in most cases. Now, let's talk about how that credit score really quick influences your rate. Basically, your credit score buys you your interest rate. The interest rate determines your level of risk. The more risk that the bank has for you or in your profile, the more money they want for interest in carrying that risk. So that is why interest rate fluctuates based on credit score. All right, so let's go ahead and move on to the next category of qualifying for your mortgage. All right, so the next one is gonna be debt to income ratio. And this one here, I'm not gonna go deep. I'm gonna do a live with one of my recommended lenders. I have not asked her yet, but I know she'll agree to come on the channel. And we'll probably do a live and we'll talk a little bit more about all of these things in more detail. We'll also look at DTI a little bit greater as well. But I'm gonna give you some stuff to be a little deadly with, just a little bit. All right, so, and just to give you a little understanding. So DTI stands for, pretty much it is a equation that divides the proposed mortgage payment plus your total monthly expenses into your total monthly gross income, okay? And that percentage comes out into a percentage that the lender uses to determine pretty much how much money you have left over, right? After all of your expenses are done. And the reason for that is they don't want you to be what we call house poor, right? At least that's what the formula, in my opinion, DTI was created to try to overcome that obstacle. So let me tell you what the minimum DTI requirement ratios are per the different loan types we just discussed. And before we do that, I do want to say that FHA gets a little interesting because they have two different ratios. They have what we call front end ratio and back end ratio, where they try to look at the two different type. So front end ratio is going to be before all of your monthly expenses. It's going to be just the household debt. So those are things like your mortgage payment, so your principal and interest, your tax escrow, insurance escrow if you have that, or just the overall total amount divided into monthly, and your MIP, your mortgage insurance premium. So they take those and then just divide it by your gross income to determine the front end ratio. So the minimum FHA or the maximum FHA debt to income ratio for your back end is 43%, essentially. And some extenuating circumstances or compensating circumstances, they will go up to 56%. We'll let my recommended lender discuss that in greater detail. The front end ratio for FHA is more restrictive. It's 31% to 40%. So one of the things you could do too is your front end ratio can be easily done by just going to a mortgage calculator, figure out what your mortgage, your principal and interest is going to be. Estimate what your taxes are. Well, actually, you can look at your public records from last year to ascertain kind of at least what it was last year. The lender is going to use last year's taxation anyway, because if depending on when you're buying, if your tax bill is not out yet, they're going to use last year's taxes to determine kind of what this year's tax will be. So you can kind of do the front end ratio on your own. Go to mortgage calculator, get all those figures, and then divide that by your monthly gross income to see what your front end ratio is. And it needs to be between that 31% and 40% range, okay? But now let's move on to conventional. Conventional, the ratio is a little bit higher on the DTI ratio. They're up to 45%. And then moving on to VA ratios is actually a little bit more restrictive than FHA. They're down to 41%. All right, so DTI ratios are going to be important to understand because that's going to ascertain how much house you can actually afford. It's not going to determine if you can So one of the ways DTIs can be detrimental to you is if your expenses exceed your income, which hopefully if it does, you're not even thinking about buying a house. You're thinking about kind of, getting more income to balance out your budget. But that's the only way DTI can be extremely detrimental. But it also restricts you on your mortgage payment. That's the main way it works, okay? Now, moving on to the last thing that you need to determine when you're trying to obtain financing is your liquidity for your down payment and your closing costs. It's very important that you understand you need to have access to liquidity, all right? If you have assets, liquefy those assets. So like if you have, another house to sell, you may have to determine and your agent in that consultation will help you as well as that loan officer to determine how you can get more liquidity, right? But you need to be preparing and planning for this. All right. So I always tell my clients to have at minimum, if you're doing an FHA loan, at minimum 5.5%. All right. Because that's going to give you 2% more to play with. At minimum 5.5%. I really want you to be about 7%. That's going to be a sweet spot. If you have at least 7% of the purchase price that you're trying to buy in your bank account or some form of asset that you can liquefy, then you are good to go if you're doing FHA. All right. If you're doing conventional, I still think that you may want to bump it up to about 9%, between 8 and 9%, depending on the type of conventional loan that you're doing. But if you're doing like a 5% conventional loan, 5% of that's going to be for the down payment. The other 3%, I would like to see at minimum 3% in the bank for closing costs, in case you don't get any closing costs from the sellers. Okay, planning your own transaction is the best way to get through a smooth transaction. Hoping that you can negotiate the closing costs in your favor is just too stressful for you to actually negotiate from a place of strength. Definitely liquidity, having that liquidity is very important. Try to be, like I said, if you're an FHA, you want to be at minimum 5.5%, but I would like to see it about 7 to 7.5%. That's going to make you a lot stronger when it comes to having that money to play with. And then conventional, I want you to be about 8%, between 8 and 9% liquidity in the bank. Okay. Yeah, that wraps up this video. I hope it was informational for you. I hope you know now how and what you need to do to qualify for your home loan. And drop any comments below. Let's have a conversation in the comments about some of the things that maybe I didn't touch on, or some more questions that now came up from this conversation. Also hit that like button and hit that subscribe button. This is just video number 2 of that first time home buyers playlist that's on the channel. I've already published video number 1, which is the overall breakdown of the process of buying the home. This is the second installment. The next installment, just so you know, will likely be contract negotiations, talking about what you need to be understanding, some of those key definitions in the transaction, so that way you can better prepare to be able to answer that question from your realtor of, hey, Where do you want to be here? You know, how many days do you want for this? How many days do you want for that? You'll be able to answer that question. So definitely stay tuned with the channel. Hit that subscribe button and feel free to reach out to me if you're thinking about purchasing or selling a home here in the Atlanta Metropolitan Area. I would love to talk with you and to schedule that consultation. Thank you for watching, and I'll see you on the next video.